Investors remain focused on the Middle East crisis and whether the U.S. and its allies can stop the clash from drawing in other countries, especially Iran. Now, Iran's involvement in the Hamas attacks are still unknown, but the country's commentary suggests they might eventually join the conflict, which could create serious oil supply issues. A full-blown conflict could push prices well above $100 a barrel and increase the likelihood of a global recession. Well, joining me now is Rebecca Babin, CIBC Private Wealth and U.S. Senior Energy Trader. Thank you so much for joining me this morning. So set the scene for us here in terms of how much of a game changer Iran's involvement would change things versus some of the other elements, as we've seen with commentary from Hezbollah as well.
So that's a great question. I think Iran's involvement is the key focus for the crude market. And this is essentially because they are a huge oil producer. They are producing over 3 million barrels of crude a day and exporting close to 1 million barrels a day. This is a huge factor as we look at how supply could be impacted, right? Right now, this conflict does not impact any crude supply. We're seeing a risk premium be built into crude prices on the fears that a country like Iran gets involved and potentially their production is impaired through a direct military strike, or we have enforced higher degree of sanctions on their exports. So that's really the key. If Hezbollah, which is Iran's proxy, starts to engage Israel from the north, that will be a sign to crude traders that this is escalating. So those two things are really kind of the key focus for the crude market as we look at this terrible conflict as it unfolds.
And obviously, with a lot of these still things up in the air, no one has, obviously committed to more countries joining the military action here. But what is this doing in terms of the outlook for oil? And what are the signals that you're paying the closest attention to in what's going to determine where oil prices go from here?
So this is an excellent point, because if you look at the outlook, where we're trading right now is still about 7% below where we were on September 28th when we made the highs of the year and crude was well in the 90s, right? So the commodity experienced a 13% sell-off in the week prior to this horrible situation in Israel. And this was driven by the fact that macroeconomic fears, interest rate concerns, recession concerns, demand destruction concerns started to filter back into crude markets. Fundamentally, though, the crude market remains very healthy. We are in a place where supply and demand are very closely balanced, if not in a slight supply deficit heading into the end of the year. The macro factors of what the US dollar does to crude demand from countries remains a huge focus. Is there a recession looming in the US is a huge focus. When I look at the physical market, though, and the fundamentals, crude actually remains very well supported anywhere near the 80s in WTI. Now, that is also really hinges on what Saudi Arabia does. They have been the key factor holding crude kind of in this stabilized range, let's call it 80 to 95 over the course of the last 6 months. They have said that they are going to roll their voluntary cuts until the end of the year, but reevaluate every month. A lot of the fundamental view hinges on what they do next. I think they stand pat, and we continue to see crude trade really well supported in that low 80s range. Now, if we get into the 90s, we do start to worry about demand destruction, which I think is a very real thing. And we will start to see those macroeconomic headwinds come in play and kind of keep crude contained. So outside of this geopolitical event, I think crude actually feels like it is grinding kind of on its base here in the 80s and has a potential to move higher should we ease some of the macroeconomic risks. The big question mark, obviously, is what happens with Israel in this conflict and how much geopolitical risk premium you wanted to apply to potential supply disruptions.
And you raise a good point, because obviously this is happening alongside the Russia-Ukraine crisis, which then was more so affecting European markets, but we did see the price of oil tick up there. So when you look at the role that Russia has to play on this, especially with sanctions coming in and price caps as well, how much potential does that have to disrupt the oil markets?
Yeah, so right now, Russian flows are generally speaking reaching the market. We don't have a lot of Russian supply being withheld from the market. The price caps, which we've blown through the prices on the price caps, haven't been strictly enforced. We did see a headline on Friday that the U.S. was going to sanction 2 vessels for infringing against the price cap. However, I don't see Russia flows being disrupted into next year. I think that we will talk about enforcing some of those sanctions on a very kind of light level, and the Russian flows will continue to make their way to China and to India because basically we need those flows on the market to keep gasoline prices at home domestically as low as they are, and we don't want to force a global recession through too strict of enforcement there. But what we're talking about is how the world is trying to redirect all the crude flows, keep the market well supplied in the midst of all of these conflicts, which is becoming more and more difficult as more conflict arises. So I don't think Russia is going to be in play next year, but obviously, things can change very quickly on a geopolitical level. So it's something you have to watch. And that's why the market is so sensitive right now. Every headline has an implication. And we're in a place where inventories are very low globally. So all of these factors could make the moves in crude larger than they might otherwise be if we had higher inventory levels.
So just quickly then, if you're an investor trying to play the oil market right now, what should you focus on and where are the gains to be had here?
That's a good question. I think the focus is going to come back to physical market fundamentals, supply and demand. And I think when we look at how we head into 24, it's all going to be about how is demand holding up? Is China demand really starting to hold up, or is it falling off because we saw all this pent up demand in 2023 and that fizzles? Is the U.S. hitting the recession? So I think that people are going to come back to those fundamental factors. In my view, we continue to see OPEC be very disciplined. And I think the play is to buy deep macroeconomic pullbacks that are overdone based on the dollar or rates, anywhere below 80s, mid 70s, and play for the upside trade there.
And as you mentioned, it's tough with every headline sort of moving markets coming out of the Middle East. Appreciate you taking the time to join us this morning. Rebecca Babin, CIBC Private Wealth U.S. Senior Energy Trader. Thank you so much.